We're going to kick this thing off today because it's 11 o'clock, top of the hour, and it's our 20-minute Annuity Tuesdays. My name is Trent Zimmermann. I'm a chartered financial consultant, chartered life underwriter. I have a background with a bachelor's in economics and a master's in finance. I'm the director of annuities here at BGA Insurance. And BGA Insurance is a wholesaler for life annuities, long-term care, and disability. And real quick before we get started, if Steve Jones, I'm gonna unmute him, ask him to unmute and give a quick intro to himself as well.
Good day, everyone. And Trent, thanks for allowing me to join you today. I'm a brokerage director here at BGA Insurance. I have been in the insurance industry for over 25 years. I've worked on both the insurance carrier side and also the general agency side. I've held regional manager positions with a couple of group insurance companies managing large multiple state territories. And for the last 10 years, I've been on the general agency side, specializing in life insurance, annuities, long-term care, and disability insurance.
Awesome. Thank you, Steve. I brought Steve in because today we're talking about when LIRP meets annuity. So last week we talked about pairing life insurance with annuities, either replacing your annuities with life insurance because you don't need them anymore, or vice versa, saying you don't need the life insurance, replacing them for annuities, and then also ways that they can work together. And we touched on LIRP. And if you don't know what LIRP is, we're going to get into it in just a second here. So just bear with me for a second. So now we're going to just do a deep dive into that pairing and how they can be beneficial to each other in this four-pillar retirement strategy we so often talk about. So to cover our bases for somebody who's new to us, who hasn't seen me rant about this, that there is a number. There's a number that if you annuitize this portion of your portfolio, you're never going to outlive your money. Your core expenses are covered. The chance in the Monte Carlo analysis of complete portfolio depletion is less than 1%. In over 75% of historical back tests, you'll show greater terminal portfolio size with an annuity than without. And terminal portfolio, the size of your net worth at death. And you've eliminated the core concerns. The number one core concern of retirees is running out of money. The on t Along with that, there are different studies that have measured this, and they're one and two, often flipping, is long-term care. And the reason it's long-term care is people fear a long-term care event will deplete them of money. So if we're planning for retirement, we have tools at our disposal that can reduce these core concerns, covering long-term care and making sure you can never outlive your money. Now, why not put all your money in annuity, especially if you're going to get a 8-9% payout rate versus the classic 4% safe money? Because at some point you're going to be living on annuitized money and you're not going to have anything to pass on. And what if you have an emergency and you need to pay more money than your monthly income? We need backstops. So I'm never going to be the person saying you should put all your money in annuity. I think that is crazy talk. But there is a number. And we've talked about this before that if you're controlling for, I want to build muscle, the answer is not spend every moment lifting weights in the gym. It's also eating right, getting enough protein, sleeping well, having time to recover. All these things go into building muscle. And right now, when we just control for growth, we're not controlling that well for income. And so there is this number, and the studies back it up. Morgan Stanley has done a 10-year long survey about this, just looking about having an annuity period, not an income annuity. And having an annuity period meant that there was a 19% higher probability of sustaining income over a 30-year period and a minimum 10% higher terminal wealth. Minimum. So we're looking at this research from Dr. Fowl about the retirement income style awareness. And the people who do best in retirement have these four pillars. An income annuity, and I say income annuity because that's the most common way of guaranteeing annuity or guaranteeing income now. Traditionally, there were pensions that could do that job. That's disappearing. So some sort of guaranteed income for life. some sort of time segmentation to say this money needs to be safe so that I have uh, funds to either increase my income along with inflation or to have money on the side for emergencies. So some sort of time segmentation, taking it out of the portfolio and putting it into a safer return. Equity growth, that's your traditional growth. You need growth in order to make retirement planning work. You need that sort of portfolio that can provide you growth in excess of inflation. And then finally, the risk wrapper, some sort of asset that's going to be buffered, that can't take the losses of your traditional equity growth, that you can pull from instead of your equity in times of emergency or down years. And so this, just having the income annuity alone, along with your equity allocations and possibly also some bond and real estate allocations, there's a lot of research that's shown this gets you much closer to the efficient frontier. The optimal portfolio of getting the highest expected returns for a defined risk level. So we've taken risk off the table and we're able to achieve more along that top end of the line here of optimal performance in terms of returns. This isn't just one study that said it. Morgan Stanley Wealth Research has done it. Dr. Fau, Dr. Blanchett has done research into this. Morningstar has done research into this. Mosh Milevsky, Botson, Zhu, Kaplan, Sachs and Sachs, Kitces, all of these have come up with the same kind of research that having these income annuities to take risk off the table allows you to take more risk and stay more invested for a longer amount of time in the stock market and achieve higher returns and be on that upper echelon of the efficient frontier. And what you get out of this is the portfolio freedom effect. Higher equity allocations, no forced selling in down years, slow AUM depletion rate, and behavior off of not having your clients sell low and buy high. So I start all this and we get into this area of the LIRP, the life insurance retirement plan, and a lot of these same things we're talking about of annuities, people are talking about with life insurance can do this too. And before we dive in, I want to pose this of annuities hedge for living too long, life insurance hedges for dying too soon. Now, both of them can do things the other can. Annuities can provide guaranteed death benefit, they can provide long-term care. Life insurance can provide income and can provide long-term care as well. But they operate on two different ends of the spectrum. So they're never going to do the other's job as well as the one built for it, but they can be in complement and concert with each other. So I think we need to move away from this idea that they're in competition and move towards using them together. So I'm going to actually invite Steve to introduce the idea of a LIRP, which is a life insurance retirement plan, to you.
Great, thanks, Trent. I think that some of you probably heard of a LIRP plan, and that's an acronym for Life Insurance Retirement Plan. I'm going to spend a few minutes giving you a brief overview of the concept and also share what an ideal client looks like to see if it might be a good fit for you, your agency, and also your clients. First of all, what is a LIRP? It is a strategy that uses permanent life insurance product to provide additional retirement income. Now, this is typically an index universal life, whole life, or variable UL policy. It's designed, a permanent policy designed to remain in force as long as premiums are paid and policy requirements are met. What this is not is a qualified retirement plan, and it is also not designed to replace traditional retirement accounts. The cash value within the policy is designed to grow on a tax-deferred basis. Now, this means that the policyholder does not have to pay taxes on the gains while they remain inside the policy. One of the benefits is that when structured properly, the policyholder can access the cash value during retirement on a tax-free basis. And this can be accomplished through either policy loans or withdrawals. This can be done, as Trent mentioned, to complement traditional retirement accounts. And unlike traditional retirement accounts, life insurance policies generally do not have annual contribution limits. Traditional retirement accounts they also usually do not have required minimum distributions. These plans can provide a flexible source of income during retirement without increase in taxable income or possibly affecting the taxation of their retirement benefits. And then last, but certainly not least, it also provides a death benefit. So if the policyholder does pass away, the beneficiaries will receive a tax-free death benefit. And now I'm going to talk a little bit more about who would be considered an ideal client for a LIRP plan. These would be individuals that have a solid financial plan in place, might be someone that you've worked with and really know their needs and what their goals are. These would be also high wage earners with a steady and stable income. They might have maxed out on their traditional retirement plan accounts, like a 401k or an IRA, and have taken advantage, if they do have a company IRA, maxing out there and also the matches that the company would provide for them. They want additional retirement diversification, additional tax diversification in retirement. And now 401ks and traditional IRAs are funded with pre-tax dollars, and these withdrawals during retirement are taxed at ordinary income. LIRPs accumulate cash value on a tax deferred basis, and the policyholder can access policy loans and withdrawals that are generally not subject to income tax. And then last but not least, long-term planners that have a need for life insurance and they want to leave a legacy for their family. Now, these LIRP plans funded with permanent insurance can be a good way to supplement and boost retirement income, but they're not for everyone. So proper planning and education are very crucial, during this planning process. That's kind of a short and sweet idea of what LIRP plans are and who are ideal clients. And if you have any questions, please feel free to reach out to me. I think, Trent, you're going to give my contact information at the end of
Yeah,
the meeting, correct?
absolutely.
Super.
So we see here that advisors are competing against annuities with these LIRP plans, saying that this is the way to design your retirement because it's tax-free income. And so there's areas that they seem to compete that you're competing for clients' dollars, and that the tax-free is better than the annuity, um, providing taxable money, and then the client perception of I already have life insurance doing this job, and I don't think those are accurate issues of competition because if we're looking at qualified funds, those qualified funds are never going to go into or so it's a different pool of money. We're only looking if it's non-qualified, and the income story is completely different, especially if it's qualified. That one is offsetting RMDs, one is pulling money out of your qualified account that wouldn't receive a step up in basis at death, and it's going to be taxable and the other is going to be tax-free income that's flexible. And then client perception, I don't think any client thinks this. I don't think any client goes in and says, "Oh, I have life insurance that's going to cover my retirement." That's something we sell to them, and that's something we propose to them, and that's I think more of a issue of perception that advisors put up for themselves rather than the clients putting up for them. Because at the end of the day, they're different. A LIRP is going to provide non-guaranteed income. It's not going to offset RMDs. You're going to have this mortality-based death benefit, so it's going to be larger than the cash value. You can turn income on and off, and it's non-reportable income, so it's tax-free. Uh, Whereas annuity is going to be guaranteed income for life. It's going to offset RMDs in an increasing basis, and cash value uh, death benefit. So whatever you have left in the cash value is what your heirs are going to receive. And you can only turn income on. I screwed this up last week and I never changed it, and I apologize. You can only turn income on, you can't turn it off. And it's increasingly reportable. Uh, if it's qualified funds, it's all going to be reportable income, but if it's non-qualified, that chunk of the money that's going to be taxable is going to grow over time. and it's 40% higher income on average when we look at these compared to a LIRP. So unless you're in the really high tax bracket and you are looking for ways of reducing your taxable basis, you're going to get more benefit out of this. Um, and that RMD offset story is really protecting that life sale if you're selling a LIRP, that you're providing that floor for income. You are offsetting the RMDs so that you're not having this ballooning RMD effect, required minimum distribution effect, because you're pulling all your money out of your life insurance. So these, it can protect the sales even. Um, and when we, uh-oh, I'm sorry, my computer shut down on me. Can you all looks like we're back online. Um, all right. So, if we're looking at the four pillars, the LIRP really works well as this risk wrapper. Now, when we look at risk wrappers, Dr. Fauci talks about IULs, FIAs, RILAs, structured notes, even VAs. Working towards this as all something that you're going to take a 0% floor or a buffered loss. You're not going to take the full loss of the market, so that if you have a down year and your portfolio is down 20%, you're not doubling down by taking an additional 4% out of that. Um, I tend to think that IUL is one of the better options in here because you can pay over time. I mean, you can do that with the VA as well, but you're going to have that 0% floor in an IUL that you're not going to have in the VA. And you have flexibility with your income. You're not just turning on income that's going for the rest of your life. You can take it for a year, you can turn it back off. There can be an arbitrage in the loan if you're advanced enough and you have somebody monitoring this, that you pull out 100,000, let's say of $1 million cash value, and now even though you are at 90% of that cash value now, you're making interest on the 100%. So you could have some chance of making money on this loan. And it's self-actualizing. I think this is one of the biggest things that if you die and you die before your retirement starts or early in your retirement, your spouse is still going to need that retirement fund to get through. And so you have an asset that is self-actualizing and will fill up to provide them with the assets they need for their retirement. And so we're also talking about the 0% floor. If you don't understand this, here's a quick primer for you. You have $100,000, the market goes down 19% in and then goes up the next year by 26%. This is a real 2-year sequence. You end up with about 2% gain. If you had a 10.5% cap, you end up with a 10.5% gain over 2 years. And if you had a 60% participation rate, you would have even higher 16% gain over those 2 years. So what that does is you're seeing this drag of volatility. If you lose 10%, don't need to make back 10%. You need to make back 11. So in these large down years that we have, where you can be down 25%, why would you want to take an additional cut out of that? That you take another 4% and you maybe tack on another 1% with fees. Now we're down, instead of 25, we're down 30%. Now you need to make up 43%. So adding a asset like a LIRP that you can say, I'm going to pull from these on down years, and even maybe the recovery years allows your portfolio to grow back up. So the result of this, we've taken all those research studies we mentioned in the front end, and they publish their data. We can take that data and we can run our own Monte Carlo analysis on this. And now it's not clean because they're not all looking at the same thing of having these four pillars. But we can introduce that into the Monte Carlo analysis and get some generalizable numbers that are probably going to be a little bit lower than reality, but we're under promising over delivering. The adding annuity improved retirement success by 12% than portfolio loan. Adding a LIRP to the annuity increased that up to 14%. Medium terminal wealth improvement by adding an income annuity was 20%. Adding a LIRP to that was 22%. And worst case scenario of adding an annuity after 30 years of retirement, with $0 remaining in your bank account, but guaranteed monthly income. So you're not going to outlive that income, but you might have outlived your reserves. Adding the LIRP after 30 years, the worst case scenario was you had 19,000 left because you weren't hit by those massive down years. No, and that's only when we did the Monte Carlo analysis of running that at just the down years, not the recovery years. And from what we've looked at from retirement stress tests with buffered assets in, is that multiplier grows when you allow the portfolio to recover. So we're at our 20 minutes here, and this is the end of it. That this is a invaluable asset to add as that fourth pillar, the risk wrapper, that I think if we're annuity salespeople, we often forget about. And if we're life insurance salespeople, we talk a lot about, but we don't talk about the first two of providing that floor and the time segmentation. So we want to be working together on this. And that's why I brought Steve in, and that's why I'm providing his uh, contact information here. If you have any questions about life insurance, setting up LIRPs, or just need to talk about a tough case, he's your go-to guy. He also has these webinars, usually on Thursdays, on a every other week basis. Steve, do you want to say anything to close out?
Really appreciate everybody's time today and look forward to speaking with you here in the near future. Thanks, Trent.
Thank you. I'll drop mine in there and get out of here. I hope you all had a wonderful fourth. I'm sorry the US lost. I'm sorry Mexico lost. It's been a tough few days for us. Um, but it was good fourth, and I hope you all had the same. Let us know how we can be of service to you, and I will see you next Tuesday.